look, I've got this great investment opportunity. I think it's going to make a bundle of money, and all I need to get it started is $5 million. Unfortunately, all I have is $1 million, and unless I can come up with another 4, then this opportunity is going to go to waste. So where am I going to get the capital I need? Who is going to lend me the money that I need to take advantage of this wonderful opportunity? Well, I'll put my $1 million aside for the moment, and I'm going to go and see if I can borrow some money. There are 2 forms in which I can borrow. I can go get debt, or I can issue equity. Debt means going and borrowing money, promising to repay it with a fixed interest payment at a date in the future, kind of like when you borrow money from the bank. Equity, on the other hand, is selling shares in the profits of my venture. That is, if you own a share of equity in my company, you're entitled to a fraction of the profits when and if the venture makes a profit. So let's see how I might arrange things. Suppose I go and I try to acquire debt by selling bonds. A bond is a financial instrument that entitles the holder to a repayment in the future. This repayment has 2 parts. First, you get a repayment of your principal. Principal is the money that you originally lent to me for this project. In addition to getting your principal back, you get interest. And interest is an extra bit of money, a reward that compensates you for your patience and for the risk that you're taking. This interest payment covers the opportunity cost of the money to you. After all, you've got your own ideas, and if I pay you enough interest, then you'll find it more profitable to lend to me and my venture than investing in your own. So, suppose I go to some people and I get them to lend me $2 million, and $2 million, they say, will require a 50% interest. That is, they want $3 million back in a year whenever this project pays off. So let me go ahead and add up. So far, I've got $2 million raised, and I've raised that in the form of issuing debt. Okay, now my other option is I can sell equity. Well, one of the things I'm thinking is I'd kind of like to get a piece of this action myself. I mean, it's my project, and therefore I'm going to hold $1 million worth of the stock in my company. Now, $1 million means that 1 million plus the 2 million I've already got is 3 million, which means I need another 2 million to pull the project off. That means I need to sell $2 million worth of equity for a total of $3 million to add with the debt and have the money I need to get started. So $1 million, my share, is 1/3 of the total of $3 million that I need to raise by selling equity. So here's the way I'm going to think about it. I'm going to hold 1/3 or 33% of the equity in this venture. That is, I hold 1/3 of the stock in this venture that I'm about to undertake. Then I'm going to go find another investor who likes my idea and get him to give me $2 million, which will be 2/3 of the equity. See, 2 million plus 1 million is the 3 million I need. I put in 1/3 of it, he puts in 2/3. So I hold 1/3 of the equity, he holds 2/3. I'm entitled to 1/3 of the profits that are left over after we've paid off our debt. He's entitled to 2/3. So let's put my equity into the pot. Let's put his equity into the pot, and now we've got $1, $2, $3, $4, $5 million. That's enough to pull this project off. Well, let's see if we get lucky. Here's my project, and I'm going to pour the capital in and see what comes out. And I'm feeling lucky, and let me see how this project pays off. So, oh, come on, baby, come on, come on. And that's it. That looks like all we've got. So, it looks like we've got 1, 2, 3, 4, 5, 6, 7, 8, $9 million came out of this project. Well, of this $9 million now, we know that we've got to pay off our debt first. And that means, let's see, 1, 2, 3, that's our $2 million worth of principal plus $1 million worth of interest. Remember that 50% interest contract, which means we've got to give 3 of these million to our bondholders. And that's that. Now that leaves for equity. We get all this rest of the stuff that's left. This is the gravy on our project, and we get to keep it, and I get 1/3 of it, and since there's a total of $6 million left, 1/3 of $6 million is 2 for me, and my other equity investor gets a total of 4, Well, that's the way it goes. See, I put in $1 million, I ended up with $2 million, I made a 100% return. Whoopee! The equity holders did really well because this project was highly profitable. Now, of course, all projects don't turn out that way. We could have put in our $5 million, and under other circumstances, we could have gotten a different kind of payoff. Let's see what would have happened if our project had not have been quite so successful. Come on. Oh, that's it. And it looks like in this case we made just enough to pay off our bond. Well, in that case, all the money goes to service the debt, and equity gets nothing. There's nothing left for equity. That is, we put our $1 million in, he put his $2 million in, and in the end, we got nothing. Sometimes that happens because when you hold equity, you're taking the risk. Bondholders get paid first. That's the way the law works. The nature of a bond contract is you get the prior claim on the returns on the project. If there's a loss to be made, equity takes it first. Well, let's suppose that we put all that money into the project and instead nothing had come out. Well, in this case, not only is the equity worthless, but the bond defaults. See, the last people to lose money in the event of the worst possible outcome are the bondholders. And if there's a default, then the bondholders suffer. See, even though the bondholders have first claim on the returns on the project, it doesn't mean that they're without risk, because in some cases, there'll be such an extreme outcome that the bondholders will get nothing as well. Well, with this little story, we can see then something about how debt and equity work. See, bonds have a principal, the money that you borrow, and an interest payment that you promise to pay when the project is over. Because of the possibility of default, because this is still a risky investment, the riskier the investment is, the higher the interest rate the bondholders will demand to lend you money, because they're afraid of getting stuck with a default in certain circumstances. Now, some bonds, called junk bonds, are bonds that you are intentionally gambling on. They pay very high rates of interest because their default rates are especially high. These are highly speculative ventures that are financed with debt financing, with full understanding that default is certainly a possibility. There are also perpetuity bonds, bonds that are issued that pay you money every year from now on. These bonds are kind of like annuities. That is, they pay you the money every year and they never mature. The maturity date is the date on which the bond repays you your original investment, the date on which you get your principal back. Bonds are issued by corporations, by the United States government, by state and county governments, by city governments. Bonds issued by city and county governments are called municipal bonds, and their interest is tax exempt. Bonds are also issued by households. They're called mortgages whenever you borrow money long term to build or buy a house. And that's the way debt finance works. Things that determine the interest rate on a bond are going to be its risk, the length of time that the borrower wants to borrow the money, and any tax consequences. That is, municipal bonds typically have lower interest rates because you pay fewer taxes on that interest. Now, let's think for a moment about stocks. Stocks, unlike bonds, never mature. When you own a share of stock, you own a piece of the equity, a piece of the profits of that company. And therefore, as long as this company is in business, whoever is holding the stock is going to get the profits anytime they're distributed. A distribution of profits is called dividends, whenever profits are paid out to the people who are holding the equities. Sometimes when you hold stock, you don't receive dividends. What would be your dividends are simply reinvested into the company, increasing its value and increasing the value of the stocks that you hold. Anytime you sell a stock for a higher price than you paid for it, what you get is called a capital gain. The extra money in excess over the original purchase price is your capital gain, or reward for holding the stock when its price goes up. If the price goes down over the holding period and you sell the stock at a loss, that's called a capital loss, the difference between the selling price and the original price at which you purchased the stock. Stocks are traded on markets such as the New York Stock Exchange, which is an ongoing auction market where buyers and sellers meet, constantly trading the stocks. When the stock is originally issued, it's called the primary market. When IBM or some other company uses an investment banker as a broker to sell stocks to mutual funds and private investors, we call that a primary market transaction. But if you take a share of IBM stock and sell it to me, perhaps through agents on the New York Stock Exchange, we call that the secondary market. IBM doesn't get any additional money, but you and I can profit by trading based on our different expectations of what's going to happen to the value of the stock. The Dow Jones Industrial Average tells you about the average price of 30 important stocks traded, perhaps on the New York Stock Exchange or perhaps on other exchanges. But it's a general measure of what's happening to stock prices day to day. There are other general measures, such as the Standard & Poor's 500 or the Wilshire 5000. These are different indexes that give you averages of stock prices, and as they move up, generally it means that people are bidding higher prices to hold the equities of companies. Other stocks are traded over the counter, that is, on a computerized network that doesn't involve a constant ongoing auction. They're traded at fixed quoted prices that brokers enter into computer terminals and broadcast to all interested parties. The most important over-the-counter market is the National Association of Securities Dealers Automatic Quotation Machine. That's called NASDAQ. The NASDAQ system is a network on which stocks of usually younger companies, and especially nowadays tech companies, are traded. So the NASDAQ, the Dow Jones Industrial Average, the New York Stock Exchange, all of these are institutions that support the exchange of equities of companies. So one final question. Why would you choose to hold equity in a company when you could hold debt instead? And the answer depends on how much risk you want to take. If you hold equity, there's a big possible upside. You may double your money. If, on the other hand, you hold debt, you can never make more than the stated interest rate that is written on your debt contract. Equity, on the other hand, is limitless in its possibility. The more successful the company, the higher your possible return. But you're always going to worry about the risk of failure.